Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at the average true range and how many traders use this to get an idea of what the volatility of the market is and then incorporate this when setting their stops. In today's lesson we're going to look at another factor which many traders consider when setting their stops, support and resistance. So let's get started.
Okay, so as we've learned in previous lessons, many traders will use technical analysis to determine where support and resistance is in the market and then look for trading opportunities based on what that chart analysis tells them. In addition to using support and resistance levels to figure out where traders want to enter trades, many successful traders also use support and resistance to determine where their stop should be placed as well. One of the most popular methods, which we've touched on in previous lessons, where many traders use support and resistance in their trading, is when trading ranges in the market. Many traders favor ranges as they provide them with the ability to enter trades with tight stop losses and much larger potential returns. The reasoning here is that traders can enter a trade just below the resistance or support level of the range, place their stop just outside that level, and then their profit target at the other end of the range. Generally, the distance between the stop level in this case is much shorter than the distance between the other end of the range, providing traders with a great opportunity for a relatively low risk and potentially high reward trade. So let's look at what I'm talking about here. We have a chart of the euro dollar here, and we've got a market range which is drawn into the chart here, and you can see here that the range that we've drawn here is 278 pips or points. If you don't know what a pip is, it's not important right now. So you can see a strategy based on entering a trade at the top or bottom of this range and then placing a stop loss just outside that resistance or support level could yield a pretty low risk and potentially high reward trade. Even if a stop loss was placed, say, 100 points outside the support or resistance line, the top of the bottom of the range here, at 278 points, it gives you still a 2.78 to 1 profit ratio, which is pretty good. Okay. The disadvantage of this type of range trading strategy is that many traders will see the same range that you're seeing there and place their entry positions close to the range, and then also place their stop losses around the same level, just outside those support or resistance levels. So with this in mind, traders, when employing this strategy, are faced with a dilemma of how far outside the range to place their stop so that they're protected if the market does move against them, but they don't get taken out on market spikes, which is the market pushing up or down just very briefly through the support or resistance level to take out a lot of the traders' stops and then reverse and go in the direction that you wanted it to go in the first place. Okay, so one method of potentially doing this is by incorporating the average true range, or ATR, which we learned about in last lesson. Here's the same market range, same chart we looked at in the last slide, and you can see here I've got an average true range plotted below, and when you run your mouse across that ATR, it'll give you the level. Most charting packages will give you a level of the ATR. In this case, if we were entering the trade right here on the second bounce off of this support line that we've got drawn in, then the ATR at that point would have been 115 points. Okay, so the strategy here would have been to enter long on the bounce there and then put the stop 115 points or 1 ATR below that long entry point. So hopefully, at that level we'd be far enough below that support line that if there was a spike down, we wouldn't be stopped out. And as you can see here on the next bounce there, or next touch of that bottom support line, there is a spike through the bottom support line on the next candle, which this time the ATR would have been 109 and we would have been outside of that range. So we wouldn't have been, in that case, stopped out on that spike through the bottom support line. So you can see here, same thing as with the last entry, the strategy would have been to enter long, and then 1 ATR below is 109 point stop below the entry price. Now, I use the the example of one here, but you know, this is something that you're going to have to play around with and tailor to your own strategy and time frame and chart that you're looking at. It doesn't have to be one ATR. It could be two, it could be three, or it could be a percentage of one. It could be 50% of one ATR, half an ATR, in terms of how far or how close you place your stop to that support or resistance line. But you get the general idea here. Now, just as an aside, we've got a little bit of a basic strategy here, so we can analyze that trade from a risk standpoint and see if it's something that would fit within the bounds which we've learned so far. So this is how you'd go about that. It's just a very basic example, but I thought it might be fun to go into right now. So here we have our range, if you remember, was 278 points, so that would have been our target for any trade that we placed on that range. And then we had a stop loss on our first trade, if you remember from the last slide, of 115 points. Okay, so 278 divided by 115 gives us a potential profit of 2.41 or 2.41 times the potential loss. So this is a good thing from a profit ratio because we're over 2 here. We have a chance to earn a lot more on this trade, more than double than we're going to lose. You know, not including slippage and commission, which we'll just leave out for simplicity's case right now. The 1 point move on the euro dollar mini forex contract is $1 per contract. Okay, so at 115 points, the stop loss in dollars per contract would be $115. Now, if you remember from our 2 lessons ago, we said 2% is a good level that many traders use as the maximum amount of their trading capital that they want to lose on any one trade. So here we have 115 divided by 10,000 if we're using a $10,000 trading capital as our example here, and that equals 1.15%. You know, with not including slippage and commission, just for this example, as our loss limit there. So we're well within our 2% loss limit here, and it looks like we have a good profit ratio on this trade, something we're going to go into a little bit more detail of in later lessons. But you know, this looks like a decent trade from a money management standpoint, at least. Okay. The purpose of the InformedTrades.com community is to hopefully build a community of traders who want to come together and learn together without all the hype that's associated with most trading education. So if you haven't done so already, I encourage you not only to visit the InformedTrades.com site, but every page on the site has a comment section, so I encourage you to actively participate by leaving your questions and comments where applicable. Okay, so that's our lesson for today. In tomorrow's lesson, we're going to look at how to set stops using some of the different charting patterns that we've learned, and you know, giving another factor there that you can consider when setting stops. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comments section below, and good luck with your trading.